You are being lied to, and it could be costing you a lot of money. Some of these are lies that you're being told by other people, by institutions that are profiting off your continued belief. But the worst ones are the lies that you're telling yourself. And the hardest thing is that part of you wants them to be true. No matter who you are, if you are investing, you will be grappling with these right now, and you probably don't even realize. So in this video, I'm going to shine a light on these lies to try and help you avoid making mistakes that could be costing you serious amounts of money. So let's get into it. In almost everything that we do in life, the more effort you put in, the better the results you get. Whether that's studying for an exam, playing golf, or raising children, the more effort that you put in, the more time that you spend honing your skills, the better the results that you're likely to get, which is why this first lie is so easy to believe. And there are several trillion-dollar industries that are profiting off this belief. If you ask the average person what they think it takes to be a successful stock market investor, they will probably tell you that they think you need to spend a huge amount of time and effort in analyzing companies, funds, reading for the financial press, and trying to interpret economic events. But this is a lie that the trillion-dollar asset management industry wants you to believe. They want you to believe that it's really complicated and that to be successful, you need a lot of experience, time, and analytical resources. And if you don't have those things, you could lose a lot of money. They want you to believe this not only because it means that then you're more likely to hand over all of your investments to them to manage, but even if you do choose to manage your own investments, if you believe that you have to be active to be successful, you're more likely to trade and buy into the products that they have to sell. The financial press and content creators are in on this too, because they want you to believe that there is value in their content, that you can and should be making tactical changes to your investments based on the events that they report on and what they have to say. But again, this is a lie. And not only does this lie prevent so many people from getting into investing in the first place because they think it's so complicated, but for those that do invest, this mantra of you needing to be active to get good results leads to a lot of mistakes. The truth is that investing in the stock market is probably one of the only disciplines where the less you do, the better your results. I know it's hard to believe because it's so counterintuitive, but for 99.9% of people, 99.9% of the time, this is true. You do not need to do a lot of research or invest a lot of time to get great results. In fact, you should think of your investment portfolio like it's a bar of soap. The more you touch it, the less of it you have. Now, before you click away thinking that this is just another active versus passive debate, sit back down because this goes way deeper. Let me show you. Every year, Morningstar produces a report called Mind the Gap that analyzes investment funds to understand how good investors are at making decisions. When looking at the US market between 2012 and 2022, the average fund returned 7.7% per year. But the aggregate return that investors in those funds received was just 6%. So 1.68% less per year. How is this possible? How can investors get lower returns than the funds that they invest in? It's nothing to do with fees. Both of these returns are net of fees. So what is it? Surely if you invest into a fund and just hold it, then you'll get exactly the same return as the fund, right? Yes, but that's not what most people do. Here's an example that Morningstar provides. This red line here shows the performance of the JP Morgan Pacific Technology Fund. If you had invested in this fund in June 2018 and then held it for 5 years until June 2023, you would have received a return of about 8%, exactly the same as the fund. But few investors actually did that. The blue bars show us the inflows and outflows of this fund. Between 2018 and 2020, you can see how money was flowing out of the fund when the fund wasn't performing that well. But in 2020, during the pandemic, technology valuations went through the roof, and this fund notched up an 82% return for that year. And we can see how after this performance showed up, hundreds of millions of dollars started flowing into the fund, which is just a classic example of investors being active, trying to be smart, but just ending up chasing performance, which, as you can see, turned out to be a big mistake as the fund fell by 55% through to October 2022. Meaning that although this fund achieved a positive return over the period, because the majority of investors' assets went in after the good performance had already shown up, on aggregate, they're now sitting at a big loss. The phenomenon that investors tend to make poor timing decisions that then results in them underperforming the funds that they invest in is well documented, with other studies finding similar results across both active and passive funds. To put into perspective just how damaging this is, if you invested £100,000 and achieved a 7.7% return for 30 years, you'd have £928,000 at the end. But if you only achieved a return of 6%, you'd end up with £580,000. That's almost 40% less. This is how much the mentality of trying to be smart, trying to be active, is costing the average investor. There's more that we can learn from this Morningstar report. Across all funds, investors underperformed the funds that they invest in by 1.68% per year. But there are some stark differences between categories of fund. The widest gap was in sector equity, where investors underperformed by a whopping 4.38% per year, whereas the lowest gap was for allocation funds at 0.46%, which makes a lot of sense. Allocation funds are designed to provide an entire diversified investment portfolio within a single fund by investing in a combination of stocks, bonds, and other asset classes, often from all across the world. So people that buy these funds are generally looking for something that they don't need to play around with. People that have a set it and forget it mentality and are less likely to react to market events. Sector equity funds, however, are used by people who want to make bets on specific sectors of the stock market outperforming. This could be a fund focused on technology, pharmaceuticals, clean energy, cannabis, AI, or any other exotic category that the asset management industry thinks that they can sell. These funds are designed for and marketed to people that think that being active is a good thing. And look at the results. Correlation is not causation, but this is certainly suggesting that the more you touch your portfolio, the less of it you end up with. Now, I often meet people that say, James, I'm ahead of the game because I already invest in index funds. But then when I look at their portfolio, they have 12 different index funds, and they're clearly making big bets on certain areas outperforming others. And then when I look at their transaction history, I can see that they keep chopping and changing between them. People often end up being very active, but with passive funds. So what can we learn from all this? We're not saying that all active management is bad all of the time, but for 99% of people, the less you touch your investments, the better the results that you're likely to get. Of course, you need to make sure that you're invested in the right thing in the first place, something that you can stick with. But this could be as simple as a single globally diversified fund. Then all you need to do is set up a direct debit so that you're investing on autopilot and you're never tempted to hold back money. And then ignore the news and get on with the rest of your life. Then the only time that you need to get active, the only time that you ever need to sell is if you need to change the risk of your portfolio, which might not be for 5, 10, or even 15 years, or when you want to spend the money at retirement. If you do this, if you truly buy into the mantra that less is more, it's likely that you're going to end up way ahead of the vast majority of other investors. So let's say that you've seen the light. You've looked at your current portfolio, at the random collection of funds and stocks that you've accumulated over the years, and in a moment of honesty, you realize that there is no real strategy behind any of it. And you've decided that you want to simplify. But when it actually comes to pushing the button and selling our existing holdings, we find it very difficult to do, especially if those holdings are at a loss. And the bigger the loss, the harder it is to sell. Perhaps you know what I'm talking about because you're sitting on one of these positions right now. Or if you don't, put yourselves in the shoes of someone that invested at this point. How would you feel about selling this when it's down 50%? It just doesn't feel right selling something that's down that much. And you'll keep telling yourself that you should wait for it to come back, at least until you get even. And what's interesting is that you can see a similar pattern of behavior with people playing roulette in the casino. At the start of the night, when they have all their chips, they bet very conservatively, trying as hard as they can not to lose money. But by the end of the night, if they're down big, they end up making very high-risk bets in an attempt to win back their money. In these situations, we lie to ourselves that this is rational behavior, that we need to stick to our guns and win back our money. But it's not rational, whether it's in the casino or with investing. Our emotional monkey brains are lying to us. And the hardest thing is that we want it to be true. As Philip Fisher, a famous American investor and author, once said, more money has probably been lost by investors holding onto a stock they really didn't want until they could at least come out even than from any other single reason. There's a trick that I like to use with clients to help them cut through their emotions and to think rationally. If you're currently holding onto a stock or a fund that is down big, I want you to think about that holding. If you're lucky enough not to be in this position, again, imagine that you bought into this fund right at its peak. Let's say you invested £20,000 and it's now worth 10. How would you feel about selling that position? Well, imagine if you woke up tomorrow and you found that that holding had been replaced by £10,000 of cash. So now you're starting from a complete fresh slate. What would you now choose to invest that money in? Would you choose to invest that money right back into the same thing? For the vast majority of people, the answer is absolutely not. They would much rather invest that money into something else. And if that's the case, well, you know what you should be doing. If you're thinking rationally, whether one of your holdings is up or down since you specifically bought it should have no bearing on your decision to keep holding it. That is why it helps to frame these decisions as if you are already holding cash. So if you recognize that there's something else you should be moving to, do it as soon as you can. Last week, I found myself in a similar situation with one of my clients. Let's call him Zach. Zach used to work for a large public company, and over the years, he was granted a lot of company stock. Even though he left the company several years ago, he's continued to hold that stock, and as of last week, his holding equated to 40% of his liquid net worth. I explained to Zach why this is an extremely risky position to be in, especially as he's only a few years from retirement, and why he should really be investing into a highly diversified, lower risk portfolio. He understood the rationale behind this and he agreed that this was the correct thing to do. But later on in the meeting, when it came to agreeing on a timescale to sell his stock, he said, "James, I recognize that this is the correct direction of travel, but what I don't want to do is sell my shares on the cheap." Given his holding and the fact that he used to hold a very senior position at the company, Zach had been keeping close tabs on this company. He said that recently it's turned a corner and is going from strength to strength, with analysts expecting its revenues to grow significantly over the next year. Zach thinks that this is a great company and he doesn't want to sell and leave all of this potential upside on the table. Which brings us to our third lie, that great companies make great investments. You've probably heard this saying before, that investing is all about finding great companies and holding them for the long term. But that's pretty obvious, right? I mean, who would want to invest in a bad company? Well, as an example, in March, FedEx released results that said that its sales were down 2% over the last year, marking 6 consecutive quarters of sales declines. Not good. Whilst on the same day, Lululemon, the activewear company, released results that its sales had grown 16% in Q4 last year and issued guidance that they expected growth of 12% in 2024. So what do you think happened to their stock prices when this news was released? Lululemon was down nearly 16% and FedEx was up 7.4%. That's probably not what you're expecting. So why is this happening? It was common knowledge that Lululemon had been doing well up until this point, growing its revenue year after year, and it was expected that this growth would continue. By Zach's definition, this is a great company. But if everybody already knows it's a great company that is poised to do well, then those expectations should already be baked into the current stock price. And given that the share price has fallen on these results, this tells us that the market was expecting Lululemon to do even better than it did. Whereas for FedEx, these results were better than what the market was expecting. I hear this kind of thing all the time when people talk about companies like Apple or Microsoft. People saying that they are great companies, and maybe they are. But that does not mean that they're great investments. It all depends on the price you pay for it and whether you think they're going to beat the potentially high expectations that are already baked into that price. Investment researcher Michael Malbuisson has written extensively on this subject, and he said, perhaps the single greatest error in the investment business is the failure to distinguish between the knowledge of a company's fundamentals, so how well you think it's going to do, and the expectations implied by the market price. I explained this to Zach and he said, okay, I see your point. I'm convinced that this company is going to grow, but yeah, I guess everybody knows that. And how the hell am I then meant to know what expectations are already baked into the price? I mean, if I think it's going to grow by 10%, but the market is thinking it's going to grow by 20%, then maybe I should sell. And I said, well, that's a good question because no one knows for certain. But what you need to recognize is that the stock price that you are looking at contains the collective knowledge and information of millions of market participants. It's already weighed in all of the known risks and opportunities that the company is facing to arrive at a consensus price that reflects what the market thinks that the company is worth. The stock market is a highly efficient machine at pricing in new information, and although it's not perfect, it's very hard to tell when it's getting it wrong and to profit from that consistently. If you want to be a successful investor and have the conviction to stick to your plans, you need to know how the stock market works. It was only once I understood its inner workings that investing really clicked for me, which is why you now need to watch this video here, where I explain how the stock market predicts the future. I'll see you there.